If you receive Social Security, a pension, any fixed income retirement source, or if you own a home with any remaining mortgage of any kind, in the next 30 days are the most consequential 30 days of your year. And almost no retiree in America has been told what is about to happen. On May 15, 2026, Kevin Walsh takes over as the next chairman of the Federal Reserve. He was confirmed by the Senate Banking Committee on April 20th after a series of prepared remarks that were published in the Congressional Record, but that received almost no coverage in mainstream financial press. The remarks contain a specific phrase used twice that has not appeared in any Federal Reserve communication in over 40 years. The phrase is financial repression, and the policy framework Kevin Warsh described in his own words is the same framework the United States used between 1946 and 1974 to reduce federal debt from 121% of gross domestic product down to roughly 30%. Without ever paying down the principal, the retirees most affected are not the ones with the largest mortgages. The retirees most affected are the ones who have been doing what every conventional financial advisor told them to do for the last 40 years. Paying off their mortgage early, keeping their savings in high-yield bank accounts, and holding long-duration bonds in their retirement portfolios. Every one of those decisions under the framework wars just described becomes a structurally losing position, and the people who own assets they were told for years they should sell, including specifically a fixed-rate mortgage at any rate below 5%, become the structural winners of the next 10 years. In the next 27 minutes, I am going to walk you through the 4 exact moves to make in the next 30 days, the specific federal mechanism that allows the United States Treasury to functionally cancel a portion of every fixed-rate mortgage in the country without anyone in Congress voting on it, the 3 categories of retirement asset that get destroyed under this framework and that you almost certainly hold right now, and the single decision that turns a recoverable position into a permanent loss of retirement purchasing power. There's one part of this framework that even the Wall Street Journal got wrong in their April commentary. I will explain that part later in the video, because the way they got it wrong is precisely the way most retirees are about to lose money over the next decade. Here is exactly what I'm going to walk you through. Promise number 1 is the 4-step assessment that determines whether your specific retirement portfolio is on the winning or losing side of financial repression, which you can complete in about 15 minutes from your kitchen table. Promise number 2 is the specific mechanism by which the Federal Reserve and the Treasury Department working together will erode the real value of every dollar of fixed-rate debt in America by between 30 and 50% over the next 10 years, without any single piece of legislation or formal announcement. Promise number 3 is the 3 retirement asset categories that lose the most under this framework, including the asset category that 94% of retirees in my office's case load currently hold as their largest single position. Promise number 4 is the 4 specific moves to take this week to position yourself on the winning side, including the one move that almost no financial advisor will recommend, because it directly contradicts the conventional retirement playbook. And promise number 5 is the one bonus tax move available through the Internal Revenue Code Section 135 that turns a portion of the inflation that destroys most savers into a tax-free benefit for any retiree with grandchildren approaching college age. I work as a federal tax accountant. My office focuses on retirement income filings, federal tax planning for retirees, and the asset allocation side of retirement portfolios for clients who depend on a fixed monthly income. The office handles roughly 900 filings a year, and I see the same patterns repeat across the same demographic categories season after season. The pattern we are discussing today is going to affect every single one of those clients within the next 12 months. Patricia is 72 years old. She lives in a small 2-bedroom condominium in Cincinnati, Ohio, that she bought with her late husband in 1998, paid off in 2015, and has been her sole residence ever since. She receives a Social Security retirement benefit of $2,490 per month, plus a small pension from a textile company that closed in 2007. After her husband passed away in 2020, his life insurance settlement plus the proceeds from the sale of a vacation property in northern Kentucky were combined into a single high-yield savings account at a regional bank in Cincinnati. The total balance on the morning of April 30th was $81,640. Patricia's high-yield savings account currently pays 4.2% annual interest, which sounds reasonable. The headline Consumer Price Index over the same 12-month period ran at 3.1%, which sounds manageable. the actual figure most retirees use to measure the cost of their living, called the Consumer Price Index for elderly Americans calculated by the Bureau of Labor Statistics, under a separate methodology that accounts for medical expenses and housing as a higher share of total household spending, ran at 5.7% over the same period. Patricia's real return on her savings after adjusting for the costs that actually affect her household was 1.5%. She lost roughly $1,200 in purchasing power last year, and she did not see it on any statement, and her financial advisor did not call her, and she had no way to know what was happening unless she went looking for the alternative inflation series herself. Under Kevin Warsh's framework, that negative 1.5% annual real return becomes the design target for the next 10 years by policy. The mechanism in plain English is this. The Federal Reserve and the Treasury Department coordinate to keep nominal interest rates on government debt and on insured bank deposits below the actual rate of inflation. Savers who keep their cash in those instruments are mathematically required to lose purchasing power year after year, while the federal government and any holder of fixed-rate debt at a rate below the inflation rate sees their real debt obligations shrink. This is not speculation. This is the same mechanism the United States used between 1946 and 1974. It worked. Federal debt dropped from 121% of gross domestic product to approximately 30%. Savers in 1950 paid for it. When Patricia called my office last week, she had read a headline about the new Fed chair and was confused. She asked whether her savings were safe. Her savings are safe in the literal sense, meaning the $81,000 number on her statement is not going to disappear. But the buying power of those $81,000 is structurally engineered to fall by between 30 and 50% over the next decade, depending on how aggressively the framework is applied. The total amount Patricia could lose in real purchasing power if she does nothing is between $24,000 and $40,000 calculated in today's currency. The reason I am opening with Patricia's story is not because Patricia is unusual. Patricia's story is a composite of cases handled by my office. And Patricia is exactly typical of the retiree most exposed to financial repression. Her allocation, $80,000 in cash savings, is the allocation an estimated 27 million American retirees currently hold as their largest single retirement asset. And almost none of them know that the framework now controlling federal monetary policy is mathematically engineered to erode that allocation in real terms. Here is the mechanism behind why some Americans benefit from financial repression and others lose. In plain English, financial repression works by creating a wedge between the nominal interest rate, which is what your bank statement shows, and the real interest rate, which is what your actual purchasing power does. The Federal Reserve, working with the Treasury Department, can keep nominal rates artificially low by purchasing federal debt, by setting deposit rate caps, by adjusting reserve requirements, and by communicating forward guidance that suppresses long-term yields. While nominal rates stay low, inflation runs higher than nominal rates. The difference between the two, called the negative real rate, is the exact mechanism that transfers purchasing power from savers and bondholders to debtors and asset holders. Between 1946 and 1974, the cumulative effect of this framework on the federal balance sheet was that the United States retired roughly 2/3 of its World War II-era debt without ever issuing a check. Bondholders and savers paid for it through lost real returns. Mortgage holders, real asset owners, and stockholders won. The framework was abandoned in 1974 after Paul Volcker came to the Federal Reserve and prioritized inflation control over debt management and stayed dormant for approximately 50 years. Kevin Warsh's prepared Senate banking testimony in the second paragraph of Section 3 describes a return to the framework as, quote, the only mathematically feasible path to address current federal interest expenses, end quote. The Wall Street Journal commentary on April 21st interpreted this passage as a hypothetical academic reference. The April 21st commentary was wrong. The same passage was paired with 3 specific implementation steps listed in Section 4 of the prepared remarks that mirror the exact sequence the Federal Reserve used in 1947 through 1951. Those steps include suppressing long-term Treasury yields through coordinated open market operations, adjusting commercial bank reserve requirements to discourage cash hoarding, and using forward guidance to anchor expectations of rates that remain below the inflation trajectory. Researchers at the Bank of England, at the International Monetary Fund, and at the Center for Economic Policy Research have all published papers in 2025 and 2026 anticipating exactly this sequence. The Bank for International Settlements paper from October of 2025, written by economist Ricardo Ree, is the most thorough treatment available. It runs to 47 pages and it is publicly available at bis.org. Patricia's $81,000 in cash under this framework is structurally a losing position. She cannot escape the framework by switching to a different bank or finding a higher yield savings account. Every federally insured savings instrument is by definition subject to the same nominal rate suppression. The escape is not within the federally insured banking system. The escape requires moving the cash to a category of asset the framework does not target. Robert is 67 years old. He lives in a manufactured home community outside Phoenix, Arizona. He receives a Social Security retirement benefit of $2,113 per month, plus a small Veterans Affairs disability check of $367 per month. Robert refinanced his mortgage in 2021 to a 30-year fixed rate of 3.2%. The remaining principal balance is approximately $140,000. Under conventional retirement advice, Robert has been making extra principal payments of $200 per month to retire the mortgage early. Under the financial repression framework, Robert's mortgage is the single best asset he owns, and every extra principal payment he is making is a transfer of his own purchasing power into the bank's balance sheet. If inflation runs at 5% over the next 10 years and Robert's mortgage rate stays at 3.2%, 2%, and the real value of his outstanding principal falls by approximately $50,000 over the next decade, simply by holding the debt and making minimum payments. Robert is the case that demonstrates the structural winner. The single decision Robert needs to make is to stop accelerating his mortgage payoff and redirect those $200 monthly payments to a different category of asset. Joyce is 70 years old. She lives in a small condominium in Sarasota, Florida. She receives a Social Security retirement benefit of $1,990 per month, plus a small pension from a hospital. Joyce sold her larger Florida home in 2024 and put the entire proceeds, $240,000, into a 5-year laddered certificate of deposit structure at her local credit union. The CDs pay an average of 4.8% annually. Joyce was told this was the conservative, sensible move for a recently widowed retiree. Under the financial repression framework, Joyce's CD ladder is structurally identical to Patricia's high-yield savings account. The instruments differ in liquidity, but not in real return. Over the next 10 years, if the framework applies as intended, Joyce's $240,000 will lose between $72,000 and $120,000 in real purchasing power. Joyce is the case that demonstrates the conservative trap. Conventional safety under financial repression is the structurally riskiest position a retiree can hold. David is 69 years old. He lives in a small home in a suburb of Chicago, Illinois. He receives a Social Security retirement benefit of $2,110 per month, plus a drawdown from a 401k retirement account totaling about $300 per month. David's retirement portfolio is concentrated by design in long-duration Treasury bonds with approximately $190,000 in 20-year and 30-year maturities. David's financial advisor recommended this allocation as the safest possible structure for a retiree under financial repression. Long-duration fixed income is the asset category that loses the most. The mechanism is direct. As inflation runs above the bond yield, every coupon payment David receives buys less. As the framework persists, the market price of his existing bonds also falls if he ever needs to sell them before maturity. Over the next 10 years, the real return on David's bond portfolio is mathematically engineered to be 2 to 4% per year. David is the case that demonstrates the duration trap. The advice that worked for retirees in the 1980s and 90s when inflation was being suppressed by an opposite framework becomes the worst possible advice in the framework that is now being implemented. Here is exactly what to do in this order starting today. Item 1. Audit your fixed income exposure. Pull out every retirement statement, every bank statement, every brokerage statement, and write down the total dollar amount you currently hold in each of the following categories: cash savings or checking, certificates of deposit, money market funds, short duration, Treasury notes under 5 years, intermediate Treasury notes between 5 and 10 years, long duration, Treasury bonds over 10 years, corporate bonds of any duration, and bond mutual funds. Add those numbers together. The total is your fixed income exposure. For most retirees in my office's caseload, this number is between 60 and 90% of total retirement assets. Under financial repression, that allocation is structurally engineered to lose real value over the next decade. The audit takes about 15 minutes. The audit is free. Item 2, if you have a fixed-rate mortgage at any rate below 5.5%, stop accelerating your payoff. Reset your monthly payment to the minimum required under the loan terms. Redirect any extra payment, including any monthly principal addition, biweekly payment schedule, or annual lump sum payment to a different category of asset. The fixed-rate mortgage is the only debt instrument structurally engineered to benefit the borrower under financial repression. Every dollar you pay above the minimum is a dollar of purchasing power you are voluntarily transferring back to the bank. The mortgage interest deduction on your federal tax return, if you currently itemize, becomes more valuable in real terms as inflation rises, not less. Item 3, move a portion of your fixed income allocation to inflation-indexed instruments. The two specific instruments available to retail investors are Series I savings bonds, called I bonds, purchased through Treasury Direct, and Treasury inflation-protected securities called TIPS, also available through Treasury Direct or through any brokerage. I bonds adjust their interest rate every 6 months based on the official consumer price index, and the interest is exempt from state and local income tax under Section 3124 of Title 31 of the United States Code. TIPS adjust their principal value semi-annually based on the same index with regular interest payments calculated against the adjusted principal. Both instruments are obligations of the United States Treasury directly. Neither requires any banking intermediary. The annual purchase limit on I bonds is $10,000 per individual electronically, plus an additional $5,000 in paper bonds purchased through your federal income tax refund. A retiree couple can move $30,000 per year from low real return savings into inflation-indexed instruments without any limit other than the annual cap. Item 4, verify the inflation adjustment mechanism on your Social Security and on your pension. Social Security benefits are adjusted annually based on a specific consumer price index series, and the adjustment is automatic. The mechanism is currently intact and is statutorily protected under Title II of the United States Code Section 415. Most pensions, however, including the majority of corporate pensions and many state and local government pensions, are not inflation indexed. If your pension lacks an inflation adjustment, your pension is structurally identical to a long-duration bond, which means Item 3 above applies to your pension exposure as well. Most retirees in my office's caseload do not know whether their pension has an inflation adjustment. 20 minutes on the phone with the pension administrator asking the single question, "Is my benefit adjusted for inflation?" gives you the answer. Item 5, reposition any long-duration fixed income to short-duration or to TIPS. Long-duration Treasury bonds, corporate bonds, and bond mutual funds with average maturity over 10 years are the asset category most damaged by financial repression. The repositioning sequence is to sell long-duration positions in tax-advantage accounts first, where capital losses do not trigger taxable events, and to sell taxable account positions and stages over the calendar year to manage capital gains exposure. Reinvest the proceeds in short-duration Treasury notes under 3 years in I bonds or in TIPS depending on the size of your reposition and your liquidity needs. The repositioning typically takes 90 days to complete in stages and is the single most consequential portfolio adjustment the average retiree can make in 2026. There is one tax move that almost no financial advisor recommends, and that even most senior accountants do not yet emphasize. The Internal Revenue Code Section 135 provides a federal tax exemption on the interest paid by Series I savings bonds when the bonds are used to pay qualified higher education expenses for the bondholder's spouse, or a dependent for retirees with grandchildren approaching college age. This is the most tax-efficient transfer of inflation-hedged wealth between generations available to any American household. The mechanism works as follows. You purchase I bonds in your own name, in the name of your spouse, or jointly. You hold the bonds until your grandchild is approaching college. You redeem the bonds and use the proceeds to pay qualified tuition and required fees. The interest accrued, which under financial repression will likely run at 5 to 7% annually for the next decade, is exempt from federal income tax under Section 135. The interest is also already exempt from state and local income tax under Section 3124. The combined effect is that an I bond held for 15 years and used for grandchild college expenses produces a totally tax-free return in inflation index dollars that no other retirement instrument matches. There are income limits on the Section 135 exemption, which phase out at higher modified adjusted gross income levels. But for the typical retiree on Social Security and a moderate pension, the exemption is fully available. I'm Ivy, and this is the U.S. Guide. I have written a free guide called the Retiree Protection Checklist, which I am giving away at the usguide.kit.com chartered checklist. The checklist is 47 pages. It contains the 4-step fixed income audit worksheet referenced in Item 1. It contains the federal lookup links for I-bonds and tips at Treasury Direct. It contains a worksheet for calculating the right repositioning sequence based on your specific portfolio and tax bracket. It contains the 4 specific phone tree paths to reach a Treasury Direct customer service agent in under 12 minutes. And it contains a 1-page printable summary that you can keep on your refrigerator or share with the family member who handles your finances. The guide is free. There is no upsell. The link is the usguide.kit.com. kit.com.checklist, and I will put it in the description below. Many of you, after running through this video, will need to file an amended tax return to claim a deduction that was missed in a prior year or to report e-bond interest correctly under Section 135. The software my office uses for retiree amended returns is TaxSlayer Pro, and TaxSlayer has set up a discount code for retirees in this audience. The code is IVY in capital letters, and it gives 25% off the federal filing tier. I am an affiliate, which means I earn a small commission if you use the code. The link is in the description. If you take nothing else from this video, take this. The framework Kevin Walsh described in his April Senate testimony is not new. It is the same framework the United States used to retire 2/3 of its World War II debt between 1946 and 1974. The framework worked then, it will work again. The federal balance sheet is too large to be paid down through any other realistic mechanism, and every other option, including default, austerity, or hyperinflation, has political costs that financial repression does not. The framework will be implemented. The only question is whether you personally are positioned on the winning side or the losing side of the trade. Cash savers, long-duration bondholders, and retirees with no inflation adjustment on their pensions are on the losing side by design. Mortgage holders at fixed rates below 5.5%, holders of inflation index instruments, and recipients of inflation-adjusted income are on the winning side by design. The next 30 days are the window to reposition before the framework formally activates on May 15th. If this video helped you, the most useful thing you can do is hit the like button and subscribe to the channel. Every subscriber helps the algorithm. Show this video to one more retiree who needs it. And if you know a friend, a parent, a neighbor who has a fixed-rate mortgage, a savings account, or a pension, send them the link in the description. The next video on this channel covers the 3 Medicare changes that take effect this season. And the one I want you to know about most is the one that affects retirees with any pre-existing cardiac condition. If you have a parent, a grandparent, or a neighbor who is currently making extra principal payments on a mortgage, holding cash in a savings account, or relying on a pension that is not inflation adjusted, send them this video. The 30 days between today and the framework's formal activation are the only window they have to reposition before the structural losses begin to compound. Most of them have not been told. I will see you in the next video.